For the past year, you've heard nonstop about the billions flooding into Bitcoin ETFs. It's been the story on every financial news channel, a tidal wave of capital hitting a new asset class. But what if I told you that's only half the picture? What if the real earth shaking shift in finance is happening somewhere else, quietly, on the balance sheets of the world's most forward thinking companies? Right now, the biggest Bitcoin buyers aren't just ETF giants like BlackRock and Fidelity. It's a growing army of public companies adding Bitcoin directly to their corporate treasuries. Their conviction runs so deep they've collectively amassed a digital hoard worth tens of billions of dollars. When you combine this corporate treasury wave with the new tsunami of ETF money, you start to see Wall Street's real bet, a full blown institutional embrace of Bitcoin totaling hundreds of billions. This is the real story. It's not just a trade, it's a fundamental rewiring of the financial system happening right in front of us. And it signals a massive change in how the world's biggest players view the future of money itself. We're going to break down the two powerful forces driving this shift, reveal the specific regulatory green lights that just blew the floodgates wide open, and analyze what this colossal bet means for Bitcoin's next push toward a new all-time high. The approval of spot Bitcoin ETFs in the United States wasn't just another product launch, it was the formal opening of a bridge. For years, institutional capital stood on one side of a chasm, eyeing Bitcoin with a mix of curiosity and fear. There was no easy, regulated, or familiar way to get across. The ETFs changed all of that. They became the official, government sanctioned front door for Wall Street to finally walk into the world of digital assets. Think about how exchange traded funds revolutionized investing in other assets. Before the first gold ETF launched in the early 2000s, buying gold was a pain. You had to deal with physical bars, storage costs, security, and insurance. The ETF wiped all that complexity away. With a simple ticker symbol, anyone, from a retiree to a multi-billion-dollar pension fund, could get exposure to gold through their normal brokerage account. The ETF didn't change gold, but it changed access to gold. And in doing so, it unleashed a tidal wave of investment that sent its price soaring. That's exactly what's happening with Bitcoin ETFs, but on a timeline that has shattered every historical record. BlackRock, the world's largest asset manager with over $10 trillion under its watch, launched its IBIT Bitcoin ETF with mind-blowing success. It became the fastest ETF in history to hit $10 billion in assets, doing in just 7 weeks what took the first gold ETF over 2 years to accomplish. This wasn't just a successful launch, it was a roaring statement of demand. Titans like Fidelity followed with their FBTC fund, and together, the new fleet of US spot Bitcoin ETFs have collectively pulled in a staggering amount of capital, with total assets under management now sitting between $50 billion and $70 billion. The importance of these money flows is hard to overstate. This isn't just speculative retail money chasing a meme. This is the calculated, risk-managed capital from the world's sharpest financial players. Wealth management desks at powerhouse banks like Morgan Stanley and Wells Fargo are now giving their high net worth clients the green light to allocate to Bitcoin ETFs. This is the safe entry point they were all waiting for. For a financial advisor, recommending a direct Bitcoin purchase on a crypto exchange was a career risk. Recommending a BlackRock or Fidelity issued ETF, listed on the NASDAQ and regulated by the SEC. That's not just acceptable anymore. It's becoming a fiduciary duty to at least consider. But to really get the institutional mindset, you have to look past the headline inflow numbers and watch the recent volatility. In the last quarter of 2025, we've seen days with massive inflows, like one where BlackRock's IBIT alone pulled in nearly $900 million. We've also seen weeks with huge outflows where over $1 billion has left these funds. A novice might see those outflows and panic, thinking the smart money is jumping ship, but that's a total misread of the situation. This isn't a sign of weakening interest, it's a sign of maturity. Institutions don't just buy and hodl blindly, they actively manage risk, they rebalance, they take profits after a big run-up and reallocate during consolidation. The recent tug of war between inflows and outflows shows that Bitcoin is no longer a one-way speculative bet. It's being woven into complex portfolio strategies. The ETFs are a two-way gate, a real-time gauge of institutional mood and risk appetite, moving in response to macro data, Fed policy, and global market shifts. The ETFs solved the access problem. They've provided a regulated, liquid, and familiar way for the biggest pools of capital to get exposure to Bitcoin. They're the public face of Wall Street's adoption. But while the ETFs open the front door, an even deeper and more permanent allocation is happening through the back door, in the treasuries of public companies, making Bitcoin a core part of their financial foundation. While the ETF inflows have been a raging river in the headlines, a deeper, quieter current has been building force under the surface. This is the corporate treasury movement, a strategic shift by a growing group of public companies choosing to hold Bitcoin directly on their balance sheets. This isn't about trading for short-term gains. It's a long-term, high-conviction bet that serves as one of the most powerful endorsements of Bitcoin as a legitimate store of value. At the heart of this movement is MicroStrategy and its visionary executive chairman, Michael Saylor. Back in 2020, when the corporate world still saw Bitcoin as a fringe asset, Saylor made a groundbreaking decision. He started converting his company's cash reserves into Bitcoin, framing it not as a speculation, but as a defense. He argued that holding cash in a world of insane money printing was like sitting on a melting ice cube. The US money supply was exploding, and every dollar in the bank was bleeding purchasing power. Saylor's solution was to adopt a Bitcoin standard. He transformed his business intelligence company into what is effectively the world's first Bitcoin development company, using the digital asset as its main treasury reserve. The scale of this conviction is just staggering. Using a mix of cash flow, stock, and debt, MicroStrategy has gone on a relentless buying spree. As of early November 2025, the company holds over 641,000 Bitcoin. Let that number sink in. There will only ever be 21 million Bitcoin. MicroStrategy, a single public company, now owns over 3% of the entire future supply. This isn't a passive ETF allocation. This is direct sovereign ownership. The company holds its own private keys, embodying the core principle of Bitcoin: self-custody and zero counterparty risk. Saylor isn't just buying a financial product. He believes he's acquiring the world's first true form of digital property. What started as a radical solo mission has now become a recognized corporate strategy. Other big names have followed. Block Inc., led by Twitter co-founder and Bitcoin bull Jack Dorsey, has put Bitcoin in its treasury. Even Tesla at one point added a major Bitcoin position, normalizing the idea. Now, the movement is global. In Japan, the public company Metaplanet has openly adopted the MicroStrategy model to hedge against the yen's weakness. In Africa, Altvest Capital has rebranded itself as the Africa Bitcoin Corporation. Today, data shows that public companies worldwide now hold hundreds of thousands of Bitcoin combined. This corporate group has become a source of huge, steady demand in the market. Unlike the two-way flow of ETF money, the corporate treasury strategy has been almost entirely one-way accumulation. These companies are, by and large, price-insensitive buyers. They buy in bull markets and they keep buying in corrections, seeing every dip as a chance to add more. This trend got a major boost from a quiet but crucial change in accounting rules. Before, US accounting standards forced companies to treat Bitcoin as an indefinite-lived, intangible asset. This meant they could write down its value if the price fell, but could never write it up if the price rose until they sold. It created a skewed, misleading picture on their financial statements. But a new standard, effective in 2025, now allows companies to mark their Bitcoin holdings to fair value each quarter. When the price of Bitcoin goes up, the gains show up on their income statement, giving a much clearer and more honest view of their financial health. This seemingly small tweak removed a huge roadblock for CFOs who were scared off by the old punitive accounting. The corporate treasury wave is a different beast from the ETF flows. Exchange-traded fund investors want price exposure. Corporate treasurers are seeking a new financial foundation. They're choosing to save in a new unit of account. This is a long-term, high-conviction play that creates a powerful and steady source of demand for Bitcoin. For any new asset to attract serious institutional money, it needs one thing above all: clarity. For over a decade, digital assets in the US existed in a regulatory fog that kept the biggest and most conservative players on the sidelines. The risk of legal trouble was just too high. But in the last couple of years, and especially in 2025, that fog has started to lift, replaced by a series of green lights that paved the way for the institutional stampede we're seeing now. The first huge breakthrough was the Financial Innovation and Technology for the 21st Century Act, or FIT21. This bill, which passed the House of Representatives in May 2024 with strong bipartisan support, is the most serious attempt yet to create a clear rulebook for digital assets in the US. For years, the industry was stuck in a turf war between the SEC and the CFTC. The big question was, is Bitcoin a security, like a stock, or a commodity, like gold? FIT21 FIT provides a test for figuring that out. It gives the CFTC primary authority over digital commodities, which includes a mature, decentralized asset like Bitcoin, while clarifying the SEC's job in overseeing assets that are securities. While FIT21 still needs to pass the Senate, its victory in the House was a watershed moment. It signaled a major shift in Washington, from skepticism to constructive engagement. For institutions, this was a massive de-risking event. The idea of a clear, congressionally mandated framework dramatically reduced the regulatory uncertainty that had been blocking the door. The second critical development was the official repeal of a controversial piece of SEC guidance known as Staff Accounting Bulletin 121, or SAB 121, issued in 2022. This rule had a chilling effect on banks, essentially stopping them from custodying crypto for clients. It required banks to hold those customer assets on their own balance sheets as a liability. This might sound like a tiny accounting detail, but the impact was massive. For a big, regulated bank, adding billions in customer crypto to its balance sheet would force it to hold way more capital, making the business of crypto custody practically impossible. In January 2025, the SEC officially issued SAB 122, which formally rescinded SAB 121. This move was a game changer. It cleared the path for banks to offer crypto custody services without facing insane capital penalties. Suddenly, the biggest and most trusted names in finance were free to build the infrastructure needed to support institutional investment. The repeal of SAB 121 didn't just open a door, it tore down a wall. These two events, FIT21's progress and the repeal of SAB 121, are the 1-2 punch that brought regulatory clarity. They are the direct cause of the institutional effects we're seeing. The ETFs couldn't launch without regulatory comfort, and the banks couldn't get involved until the accounting roadblocks were gone. This new environment is the why now. It's why, after years of hesitation, the dam of institutional capital has finally burst. The sheriffs have arrived, they're starting to draw the town map, and that's giving the world's biggest investors the confidence they need to finally move in. So, the ETFs provide the access, corporate treasuries show the conviction, and new regulations offer the clarity. But what's the real driver behind this whole movement? Why are the smartest players on the planet making a multi-hundred-billion-dollar bet on a 15-year-old internet protocol? The answer isn't in the crypto market. It's in the seismic shifts happening in the global economy. This is a story about the very nature of money. The main catalyst is what many are calling the Great Debasement. Since early 2020, the US M2 money supply, a broad measure of all the dollars out there, has expanded by a stunning 44%. To deal with the pandemic, central banks globally printed trillions of dollars out of thin air, and that has consequences. When you dramatically increase the supply of something, each unit of it becomes less valuable. Every dollar in your bank account, in a corporate treasury, or in a pension fund is being diluted. It's losing purchasing power. This is the problem Michael Saylor saw early on, and it's the problem every sophisticated investor is now scrambling to solve. In this environment, holding tons of cash isn't safe. It's a guaranteed loss. Institutions are desperately hunting for assets that can act as a store of value, assets that can't be devalued by government printing presses. For centuries, that asset was gold. Today, many see Bitcoin as its digital successor, digital gold. Like gold, Bitcoin is scarce. Its supply is mathematically capped at 21 million, a hard limit enforced by a global network that no single person or government can change. This verifiable scarcity is its killer feature in a world of infinite paper money. Plus, the creation of new Bitcoin is cut in half about every 4 years in an event called the halving. The most recent halving, in April 2024, slashed the new supply from 6.25 Bitcoin per block to just 3.125. This programmed supply shock, colliding with the new wave of institutional demand, is the simple, powerful economic formula that many analysts believe will drive the next major price cycle. Beyond just being a hedge against inflation, institutions also love Bitcoin for its diversification benefits. Over the last decade, Bitcoin's price has moved with a low correlation to stocks and bonds. Adding even a small amount of Bitcoin to a traditional 60-40 portfolio has been shown to potentially boost returns while lowering overall risk, the holy grail for portfolio managers. This is the exact argument made by experts like Chris Kuiper of Fidelity Digital Assets, who highlights Bitcoin's unique properties for institutional portfolios. This perfect storm of factors has led to some incredibly bullish forecasts from the heart of Wall Street. Analysts at JPMorgan have thrown out a potential price target of $170,000. Tom Lee of Fundstrat, a longtime Bitcoin bull, sees a path to $200,000. And Kathy Wood of ARK Invest has stuck to her long-term target of over $1 million per Bitcoin in the next decade. These aren't wild guesses from internet trolls. They're data-driven projections from respected analysts based on the sheer scale of institutional money now pouring in. Bitcoin has already proven its power, hitting an all-time high of over $126,000 in October of 2025. While the price has since cooled off and consolidated, a typical pattern after hitting a new peak, the underlying thesis is stronger than ever. Exchange-traded fund demand is creating a constant floor in the market. Corporate treasuries are swallowing huge amounts of supply and locking it away. And the halving has made sure that new Bitcoin is scarcer than ever. This isn't just a bet on a technology. It's a fundamental response to a changing world. Wall Street is betting on Bitcoin because it's betting against the endless expansion of fiat currency. It's a sanctuary of absolute scarcity in an ocean of monetary dilution. What we're watching isn't a bubble. It's a methodical, calculated, and fundamental reallocation of capital. The story of Wall Street's massive bet on Bitcoin is being written in three connected chapters. First, the ETF Tsunami, which built the regulated bridge for trillions in managed money to finally cross into the asset class, smashing records and proving years of pent-up demand. Second, the corporate treasury wave, a high-conviction movement led by visionaries building their financial foundations on a new digital standard, turning their companies into long-term accumulators. And third, the regulatory green light, a series of deliberate actions, from the FIT21 Act to the repeal of SAB 121, that cleared the fog of uncertainty and gave the world's most conservative institutions the clarity they needed to finally get in the game. Together, these forces represent a profound and probably irreversible shift. Bitcoin is growing up, moving from a retail phenomenon to a legitimate institutional-grade macro asset. The conversation has changed from, is this real, to how much should we own? In boardrooms and on investment committees, the discussion is no longer about the risk of allocating to Bitcoin, but the risk of having zero exposure. We are still in the early innings. The major wirehouses are just starting to bring their advisors on board. Pension funds and sovereign wealth funds, the largest pools of capital on Earth, have barely started to make their moves. As staggering as the numbers are now, this may only be the opening act. The question isn't if institutional finance will adopt Bitcoin, but how fast and how far it will go. With Wall Street's biggest players now in the arena, what does that signal for Bitcoin's next major cycle? If you want to stay ahead of this story and understand the forces shaping the future of finance, make sure you subscribe to the channel and ring that notification bell. The great capital migration is here, and you won't want to miss what happens next.